Negative gearing explained in 3 minutes.
Meet George. Let's say in this hypothetical scenario that George earns an annual salary of $90,000. Now, of course, George has to pay some tax on that, and his tax payable is $21,517. But George has an investment property, and that investment property gives him $31,200 per year in rental income. However, George has to pay all these expenses in return for holding that investment property. And let's say those expenses in total end up being $51,200. So George has made a cash flow loss of $20,000 on this particular property. However, what happens to that $20,000 loss? Well, it gets added to his taxable income. So that means his taxable income is the $90,000. He still earns that. It's not as if he got a pay cut. It's the $90,000 minus that $20,000 cash flow loss, which means that his new taxable income becomes $70,000. Or put another way, he only pays tax on $70,000 rather than $90,000. And that brings his tax down to $14,617. But hold on, remember, George paid $21,517 in the tax year, but he should only have paid $14,617. So that means George gets a refund. And the refund is the $21,517, which is a tax on his $90,000 income, minus the $14,617, which is the tax he now pays due to his taxable income coming down to $70,000. That means George gets a refund of $6,900. So what's the net result? The property gave George a $20,000 cash flow loss. In return, the government gave him a $6,900 tax refund. That brings his net loss down to $20,000 minus the $6,900 refund, means that he ends up making an actual loss on cash flow after tax of $13,100.
And that is how negative gearing works. Comment below if you've got questions.